Hello everyone. We have today with us Pankaj Murarka of Renaissance Wealth Creators, and they are into wealth creation, and of course he's an expert on stock market. And I would be asking him some questions. And on a day we are doing this interview when stock market is doing really well, it's firing on all cylinders. In fact, the broader market is also participating today, and after a long time, I'm seeing. 32,000 on the mid cap 100 thing, it has crossed that market. So Sensex is also across 61K, and Bank Nifty is above 43,000. Wow. And Nifty is above 18,100. 18,000 it has crossed. But so market is really doing well. And Pankaj, you're probably the lucky charm for the markets.
I wish so. I wish so. I think you're right. Markets have been flattish in that sense at the Nifty index level for the last 18 months. But I think one of the bigger headwinds facing equity markets for the last 18 months was rising interest rates and high inflation.
Yeah.
But I think we got to a stage where interest rates have risen significantly, and more importantly, inflation has started showing signs of slowing down. And our expectation is probably by the end of this year, globally also inflation should moderate considerably. More importantly, despite all these challenges, Indian economy has continued to do well. So I think my view is that Indian outlook for Indian economy continues to remain strong, and we remain fairly positive on the markets in that framework or in that construct, because the underlying growth is very strong in Indian economy. And if that is the case, then markets will do well. In fact, our view is that by the end of this year, calendar year, we think Nifty index can actually make a new all-time high, because we think earnings for corporate India is fairly strong and robust. And in that context, we continue to remain very positive on equities as an asset class and markets in terms of directionally from a medium-term to long-term perspective.
Okay, Pankaj, we've been in a flattish market, and in fact, this bear market has been on since 2021. So, is this a breakout that we were waiting for? Do you see 19,000 approachable by the end of this year? Of course, we are only in the middle of the year, but do you see it happening soon?
Actually, Anupam, I think markets can not only get to 19,000, but our year-end target is higher than that. So we think markets will make a new long-term, new all-time high. What we are seeing essentially is, despite this headwinds of rising interest rates, Indian economy is continuing to do well. Underlying consumer demand and consumer sentiment in India continues to remain very strong. For example, in a city like Bombay, what I read over the weekend was last month of April had the highest real estate sales, monthly sales in the last 10 years. And real estate market has been extremely strong for the last 10 years. And that is with the top 10 cities in India, where the real estate demand is very, very strong. So I think that's a reflection of strong consumer sentiment. And apart from that, there are various other data points also which show very strong urban demand. So corporate sector is doing well, consumer sentiment is very high or healthy. And on top of that, government is been investing into infrastructure. And plus, we are seeing revival of private sector capex. So combination of all of this, we remain very positive on the markets, and we think markets can actually make a new lifetime high or all-time high by the end of this year. And the next couple of years, Indian equity should do well. The last 18 months of consolidation, where index has been flat, has made valuations more reasonable in that sense, because in the last 18 months, things have grown at about 20%. Whereas the index is flat. So the same index is 20% cheaper now, because earnings EPS has grown by 20%. So in that sense, valuations have become reasonable. So I think investors should invest into the market, and market should do well from here on.
Yeah. Okay. You're saying that this real estate rally that we are seeing. Do you think this would continue for some time? Because some experts believe that this can continue up to 10 years or even 15 years. Because after a long time, reality is seeing this push. So for how long do you think this can continue? Because mostly it is in the premium segment. It's not in that middle thing and the lower middle class thing. So do you see this continuing? Because after some time, the premium segment can get saturated. So for how long do you think this can continue?
I think this can continue for a very long time. I'll give you an example. US had a real estate cycle in the 90s, which lasted for almost 20 years. I think
Yeah.
India is changing very fast. There is a huge amount of job creation that's happening. You look at IT companies, they've been hiring very vigorously over the last 3 years. Likewise, we're seeing revival of India's manufacturing, where new manufacturing capacities are being set up. It's Apple, which
Mm.
is now going to is manufacturing about close to about 10% of iPhones in India. Global production of iPhone is being done from India, and that number will go to something like 25% in the next 3 years, which effectively means significant amount of job creation in India. And likewise, we're seeing a lot of new manufacturing coming up in India. So all of this will lead to a lot of job creation across the low income and middle income layers of the society as well. And as that happens, I'm sure all of these people would want to buy a house. So I think my view is that housing as a sector or real estate sector, the trend for the sector has changed, and I am very hopeful that this strong demand in real estate in India can continue for the next 10, 15 years. I mean, this is something similar to what has happened in many other countries and economies which have gone through a similar growth and development cycle.
Mm.
So I think this is not a flash in the pan. In fact, this real estate cycle can continue for the next 15 years.
Okay. So should people invest in real estate stocks?
Yes, one should invest into real estate stock. Just that while select investing into stock, one has to do a careful financial analysis of those companies as well.
Mm.
So not all real estate companies will do well just because the real estate sector is doing
Yeah.
well. You look at companies which have strong balance sheet, which have good reputation, and who can complete projects on time, and who have
Mm.
brand equity from customers, because customers have become very choosy. They check for the credibility and brand equity of the real estate developer, and only then they purchase or invest into real estate because they want timely completion of projects. So all
Mm.
of these factors need to be considered, but I think I completely agree with you. Real estate sector and real estate stocks will do well.
Okay, now we're talking about reality, but there's one sector which has taken a lot of beating, which is the IT sector. Now, some believe that it has taken a lot of beating and the valuations are now real. So, should we accumulate some stocks because, like stocks like Infosys and all, they've taken a lot of beating, and because of the Q4 result and the foresight was not that they were not very bullish. So, do you think it is a good time to accumulate stocks which were very expensive and which are good, solid companies which have given good returns in the past? So, is it a good time to accumulate such stocks, or should we hold on and wait for some time?
No, I take your point. IT sector has seen a fair bit of correction in the last 18 months because one, the valuations in the sector was expensive 18 months back.
Mm.
Also, there has been this fear or apprehension about recession in US leading to slowdown in IT companies.
Yeah.
For the last 18 months, what we've seen is software have corrected a fair bit, and as a result, valuations have become far more normalized in that sense. I certainly think the long-term outlook for Indian IT sector remains very good. Uh, I think all of us understand this. 50% of uh, software engineers all over the world are Indian origin.
Mm.
So India is very key to the global technology sector because we produce, whether those engineers are working in Infosys or Microsoft or Apple, 50% of these engineers come from Indian origin. So India is very central to the global evolution of technology globally. And I think IT as a sector will do well, and Indian companies will certainly do well. And as you rightly mentioned, the stock prices have corrected and valuations have become far more moderate in that sense. So I think actually for a long-term investor, this is a very good time where they should start accumulating the large cap IT companies gradually over the next 3 to 6 months with a 3 to 5 year time horizon, because the long-term outlook for IT as a sector, given that technology has become so central to everything in the world,
Mm.
IT is essential for every business. So IT will continue to grow, and Indian companies will do well. So this is really a good time for investors to really accumulate IT stocks from a longer term perspective.
Yeah, okay. Now there's some threat emerging from the from within IT itself, information technology, which is the AI. Because of AI, lots of people, a lot of companies are filing their stuff. Because they can. I read some news in the morning itself. Now, how do you see this challenge? As because if someone is accumulating a stock for say 5 years or something, because of this AI challenge, if people are fired, if attrition is high, then how do you see this whole scenario play out? I mean, of course, we don't know what will happen in future, but if someone is investing for future, so how do you look at this?
Well, I don't see AI as a risk for the IT sector. In fact, only it will only accelerate IT sector's growth.
Mm.
Every 10 years, we have a new technology evolution. Go back 40, 50 years, there used to be IBM supercomputers. And from there, when we migrated to much faster processors, there
Yeah.
was a fear that computers will eat into everyone's job. Or once when the world transitioned into the new century after Y2K, there was a fear that computers will eat into the job of all the lot of people who are doing low-end jobs and so on and so forth. But that has not happened. Computers have only helped us become more efficient, more productive, and improve or enhance the skill set of people. So I don't see AI or the evolution of Chat GPT and Bard, Google Bard in that sense is any risk to the sector. In fact, it will help us automate a lot of low-end job and train people to do much more value-added job, enhance their skill set and do much more value-added job so that they can earn actually better and become more efficient. So I don't think so. There is any need to fear job losses emerging out of AI. I don't believe so.
Okay. Okay. Your take on the pharma stocks, because they're back in reckoning after a long time, and some of them are advised by also, recommended. Like, I wouldn't like to take some names, but we know the obvious names, the big hospitals and all that, and they're expanding also. And we are seeing the medical tourism thing coming back also a bit. And by 2030, they are likely to see, bigger growth. So because of that, major hospitals are expanding their chains and opening more, or they are also growing in organically. So is this the right time to enter pharma stocks? Actually, some have actually become expensive. There was a 6 months back they were cheaper. So is this the right time to enter in pharma stocks?
So let's break the pharma sector into two segments. One is the pharmaceutical companies which are making drugs and molecules,
Yeah.
and second is the hospital sector, which is
Mm.
providing services in terms of cure and everything, and which is influenced or
Mm.
impacted or from medical tourism and stuff like that.
Mm.
So I think the outlook, as far as hospital sector is concerned, I think it will do very well because all of us know there's very steep underpenetration of medical services in India. Even today in India, we go to tier two and tier three cities and rural towns and villages, and still there's lack of good quality medical facilities, which effectively means we need to make significant investments in medical facilities to make good medical facilities available to all Indians. So
Mm.
the sector will continue to remain on a growth path for a very long term. And on top of that, because India is a cheaper place to get your medical cure and treatment, a lot of people from different parts of the world come to India. And we have the best in class professionals in terms of doctors and support staff to provide medical facilities in that sense. So
Mm.
I think hospitals as a sector will continue to do well for a very long period of time, and investors with long-term view should certainly invest into the sector. As far as the pharmaceutical companies or companies which make the drugs and molecules are concerned, again, that piece of the segment has not done well over the last 3 years because of pricing pressure in the US market, because all these companies have a big exposure to supplying drugs or exporting
Mm.
drugs to US market, and there have been severe price competition there. Price erosion has been happening,
Mm.
and which is why pharmaceutical companies have actually been seeing earnings degrowth in the last 3 years. But I think we have reached a stage now where prices in the US for drugs or medicines have started stabilizing. And from this year onwards, we'll start seeing healthy earnings growth in the pharmaceutical sector as well. So I think within the pharmaceutical sector also, one should certainly make investments. But having said that, one should analyze the company properly before making investment, because not all companies will do well, because pharma is a very diverse sector.
Yeah.
So pharma as a sector will do well. And more importantly, the good thing is in a year where US will get into a recession probably in the second half of this calendar year, and so will European economies. Pharma is a very good defensive sector in a year when there's a global recession, because people will keep consuming drugs
Mm.
irrespective of economic cycles, because you cannot postpone not having drugs when you're undergoing a treatment or you need to have some of your medications on a continuous basis. So it's a very defensive sector in that sense. So I think pharmaceutical sector will do well. So I would say investors should invest into both these sectors at this point of time.
We've come to the themes. We've discussed IT, we've discussed pharma, but we see a mad rush in these railway stocks, RVNL, Aircon, IRCTC, and all the wagon related stock also like T-Tiger wagons and all that. So do you see this rally continuing for some time, or do you see this just for some time, a short term rally?
No, on a broader theme, I think capital goods as a sector or engineering and capital goods as a sector will do well. We are very positive on that as a sector because we are seeing significant investments happening in the Indian economy, both from the government side also, and of late, over the last 2 years, we are seeing early signs of revival in investments from the private sector also. As far as railways is concerned, railways has embarked on one of their biggest capex cycle or investment cycle in their life, which Indian Railways has not done in the last 70, 80 years. So Indian Railways is on a very big investment spree, if I may say so, to upgrade the whole railway network across India, and more importantly, invest into new railway network, be dedicated freight corridors across the western north of India, or the east-west corridor, or the west and south corridor, and stuff like that. And likewise, there are many more projects, including the bullet train, the first bullet train has been planned between Bombay and Ahmedabad, which hopefully should get commercialized some by 2026-27, and on which work is undergoing. And likewise, there are various other ambitious projects, including electrification of locomotives and so on and so forth. So I think Indian Railways is on a very big investment, spree in that sense. And as a result of which, a lot of companies will benefit out of it. So I think railways as an investment theme is very exciting and interesting. But having said that, I would still recommend that investors should not just buy companies blindly because they are linked to railways. It's very important to do proper study and research before they invest into companies, so as to figure out which are the companies which will be long-term beneficiaries of the entire investment by railways. So railway capex or railway investment, I think, and defense capex and defense investment is a very compelling investment theme from the next 5 to 7 years point of view. But at the same time, when it comes to investing, one has to be careful to do proper financial analysis and due diligence of companies and then invest, because not just because railway is going to make investment doesn't mean that every company which is in that business will do well. Some companies will do well and some companies might still not do well, because some companies might either not win tenders, or even after winning tenders they might not execute them well, or at times some companies might bid tenders very competitively at very low rates, whereby even after winning tenders it might not be profitable for them. All of this need to be looked into and analyzed deeply before investing into a particular stock or a business. But on a broader theme level, I completely agree with you, Anupam, that railway investment and defense investment is a very compelling thing, because both of them are going to grow significantly over the next 5 to 7 years.
Okay, so railways and defense, you said. What about financials? Now, if someone has missed the rally, it's like ICICI is out of reach actually for most of the people, and in fact, like stocks like Bank of Baroda and even PNB. So now, for someone who has not participated in the rally so far, is this the time to enter, or the person should wait?
No, I think this is a good time to invest into equities, including financials. We continue to remain very positive on financials. Indian banking system is in great health today. In fact, after a gap of 10 years almost, I'm seeing that banks in such shape, Indian banks being in such a good shape from asset quality and NPA perspective, because we had a big NPA cycle in banks in 2018-19, where a lot of large accounts where banks had significant exposure across steel and various other infrastructure industries had gone slipped into NPAs, and bank had to take the entire banking sector to take huge losses out of NPAs. But after cleaning all of that, now we are at a stage where India's banking sector's balance sheet is looking the healthiest that I have seen in the last 15 years. So I
Mm,
think the outlook for Indian banking sector is very good or very healthy in that sense. And I think investors should invest into the banking sector because banks are doing well and they'll continue to do well. I don't think so that it's too late. Only thing is investors should have a 3 to 5 year time horizon when they invest into these names. So we like all the leading private sector banks in India. And apart from that, within state-owned banks also, we like State Bank. We think it has immense value from an investor
mm,
stockholders' perspective because the bank is doing incredibly well, and the stock is still very, very reasonably priced in that sense, or at a significant discount to its prior cycles valuation multiples. So we think it's a very compelling buy in that sense. Just one caveat that some of these names I'm mentioning, we obviously have invest our own investments into these companies. So investors should do their due diligence before they invest into these companies.
Okay, so they should enter in big banks or small banks. Like even the quarter four results of some of the mid cap and small banks are very good. And so should they enter in those, or they should stick with some safe names?
If you really ask me, I think investors should build a portfolio with a combination of both because we
Mm,
are at a time when both large banks and mid-cap banks will do well.
mm.
So investors should just build a portfolio with some large banks and few mid-cap banks and have a combination of both in their portfolio.
Okay. Okay, so now how to look for good stocks? Now this is something like many people ask me. You know, because like as you said that you have to do due diligence and all that. Now the common man doesn't have that much time and understanding also, which is okay. So how to look for a good stock? Like what happens is by the time you recognize that this is a good stock, it becomes expensive, and then you buy it expensive, then there is a correction. So then you have to wait till the time it reaches the price at which you bought it. So how to make that perfect choice at the right time? Now I know it is tough to time the market, but how should a common or retail investor choose a stock?
Well, very good question. I think my sincere advice to all the investors, retail investors, and common investors would be the world has become very fast changing, and
Mm,
due to evolution of technology, things change very fast. Businesses are being changing very fast because technology is challenging every business. So once upon a time, there used to be Walkmans when the iPod and the music and digital Walkmans became irrelevant. They used to be Kodak, and then we had cameras on the phone. So businesses do get challenged in that sense. So when it comes to investing, investors should invest into companies after doing their detailed research. In case investors, and which requires a fair bit of time and effort, if they don't have the time and effort, I would sincerely urge them not to invest into stocks directly and probably invest through mutual funds and other alternate vehicles because you can hire the services of best of the professional managers at a very reasonable cost of pricing in that sense. Having said that, if investors have the time and perseverance to research companies, then they should try to read through the annual reports of the companies, try to understand the business
mm,
of the company, and then look at the annual reports to get a fair judgment about how sound those companies are financially. And finally, and then once they get comfort and all of that, they should look at the valuations of the company. So it's a very elaborate process. Generally, I've seen a lot of investors who they end up buying stocks of companies which whose products they've used and they like the product. So there's been a lot of
mm,
people, for example, I know a lot of my friends going back to 2010-11 when they bought their first iPhone in 2009, 2006, actually 2006 and 7, when iPhone was launched, they found it such a great product that they just went and bought Apple stock because they said if the
mm.
company can make such phenomenal product,
Yeah.
then the stock has to do well. And they've
Mm,
made, the stock has multiplied 50 times over the last 15 years.
mm,
So it's done phenomenally well. So generally, and that's not a bad idea that if you use some product and if you find that product is extremely great or outstanding, then you should try to do some research on the company that is the manufacturer of providing that product or services and probably use some of your financial acumen to do some research on that company and probably then buy that business. probably I think that's the simplest way for a common retail investor to get started into investing, and then from there on they have to build on to their own models.
Okay, so it's like look around you, what you are using, what you are eating, what you're watching, or whatever. Okay, now, but even in this, there is a catch. Whether you should go for with the momentum, or you should look at the fundamentals, or you should look at the technical charts, or it's a combination of all these things.
Well, for long-term investors, technicals are irrelevant. So
Hmm.
because we invest for the 3-year, 5-year time horizons,
Hmm.
there's no one right formula that that one should do this and then you can make. There's no certainty in investing, and there's no. It's not a mathematical formula that you will not get exact outcomes out of investing. If it was a mathematical formula, then machines would have done it.
Yeah.
So obviously, evaluating a business, investors should look at everything that relates to that business in terms of how good the product or services that business is offering, and how good are the people in terms of the reputation of the company and the people running that company, and is the company financially stable and sound. And
Hmm.
once all of that is checked, then investors should look at finally at the valuations as to what price you are paying to buy that company or buy that business. So I think one has to do a slightly more comprehensive and detailed study, and one should look at all of these factors and before one arrives at a decision.
Yeah, or leave it on your advisor if you don't have so much of
I
time.
think, yeah, absolutely, because the world is changing very fast,
Yeah.
and which is why one has to. I always say that one has to invest one's time before you invest your money.
Hmm.
So either you have the time to invest, and if you don't have, then give it to some other professional who can invest that, who would invest his own time on your behalf and do all the research and analysis on your behalf. Either your advisor or some mutual fund to whom you might give your money, and let them do that for you. Because see, we don't take chances with our health. When we fall
Hmm.
sick, we go to the best hospital.
Yeah.
Likewise, I think the investor should take chance with their wealth when you
Hmm.
and try to experiment with your wealth. You should go to the best of the advisor or to the and take their advice rather than trying to experiment on your own self, because if you get it wrong, it can have significant impact on your own financial well-being, which is not good in that sense.
Yeah. Okay. Now, the other thing which most of the people ask is that when to sell a stock. If someone has made, say some money, that can be according to the person, 20%, 10%, whatever. So when should the person sell a stock? This is mostly people ask because, after buying, suppose your money has multiplied, or actually what happens is that mostly this is that, the stock has fallen, or the company is good. So what to do now? Now you are like, should I sell this? It may rise again in the next quarter if the results are good, or the company does something because the management is good. So when should someone sell a stock?
Very good question. So see, there is no defined right time or right price to sell a stock.
Hmm.
For a long-term investor, if the company is doing well, then one should not sell it, because when we buy a stock, it's essentially something like a partnership or ownership in that business. If the business is going to keep doing well, then why should one sell the stock? Let's just think
Yeah.
about some of the large companies here, like something like HDFC Bank or Infosys or a Sun Pharma or Bharti Airtel. All of these companies 20 years back were very small companies. Someone who bought these companies or their stock 20 years back and just sat on it for the last 20 years has done phenomenally well, because these companies also, like Indian economy, have gone through multiple crises, but yet they've kept on growing year after year, and over the years their business has multiplied many-fold, and
Hmm.
they've delivered phenomenal wealth creation to their shareholders. So if you're owning a good company, then actually, irrespective of there can be short-term volatility in the stock because the company's results for 1 or 2 quarters are not good. Stock has fallen in the short term. But as long as we are long-term focused and that company's long-term prospects continue to remain good, one should actually never sell a stock. Meaning, HDFC Bank has been giving 25%,
Yeah.
20 to 25 bigger returns every year for the last 25 years. So if that is the case, then why should one sell HDFC Bank, right? It's been such a,
Hmm.
and people hold on to stocks like HDFC Bank or Infosys or Bharti or Sun Pharma or take any other name for that matter, let's say, they have seen the real wealth creation through the compounding. So I think long-term investors, if the company is good and the management is good and the business is strong, I would suggest that as a long-term investor, you should just sit on it for a very long period of time. In India, we have this trend or phenomena behavior in Indian society where a lot of Indians buy real estate and then they never sell it. They pass it on to the next generation, right? So I always tell investors that just like you buy real estate and then you pass it on to your next generation, you should buy good company stocks and you should never sell it in your lifetime. You should just give it to your next generation. And that's the best gift you can give to them because in long term, equities will give much higher return than real estate. So if the company is good and you're buying really rock solid company, then I would suggest that just buy it and hold it for the next 10, 20, 30 years because India is in a great shape. India economy is doing well. And in that context, Indian companies will do very well.
And the word patience is virtue, as they say. Most of the people don't have that patience, and they become uneasy after even say 1 year of investing. Okay, so this is my last question, but this is my last question. FDs have now become good. Okay, so they're giving good, decent returns. The banks are upping their thing when this all investors are going towards equity. So FD should be a part of the portfolio, and how much of the allocation in the portfolio should be in FD?
See, well, investors should have some exposure to fixed income. Now, how much fixed income exposure investors should have really depends on the risk appetite and return expectations of every investor. Now, it's also a function of their cash flows. So I've seen investors who are 100% equity, the investors who split their portfolio 50-50 between equity and debt, and the investors who have like 70% of equities and 30% into debt. All we know is that over a longer period of time, over a 3-year, 5-year, 10-year cycle, equities will give returns which will be much higher than the fixed income. Last 20 years in India, the index has given returns which is 2x of the FD. So, equity returns at the index level are double the FD returns.
Yes.
So investors, yet having said that, equity returns are volatile. These returns do not happen on an every year basis because there could be some years where equity returns can be negative also. So investors want to have some stability in the portfolio, and they might want or they might have needs for regular cash flows to meet their expenses or other requirements. So depending on their needs and requirements, they should have some money in fixed income. Now that will really vary from person to person. But after having met those needs, I would strongly urge investors to have put rest of their money into equities with a long-term time horizon because Indian equities is going to be the best performing asset class over the next 20 years. And not only that, Indian equity is actually going to the best performing equity markets in the world. So you don't want to miss on the Indian equity story over the next 20 years. So I would strongly urge investors to put their excess saving beyond their requirements into equities, but whatever money they need for their short-term purpose or for portfolio stability, probably that is the amount they can put in fixed income or FDs. And now that will vary from investor to investor.
Okay. So thank you, Pankaj, for this interview. Thank you for joining me on this interview because these are some basic questions which clients ask me, which other people also ask me. FD and or equity, because people are actually scared of stock market, as if if you put your money there, it is going to just blow up. And so from my end, I'm trying to assure people that is not the case, and I need help from you guys, big guys, who are into this business since a very long time. That's why, and I've been a journalist, so a TV journalist. So now I'm into this. So I thought, let me talk to people who are in this business, who have been helping people invest and successfully invest, and who've seen all the up downs of the stock markets. So thanks a lot for joining me on my channel, and thanks a lot for this interview.
I truly appreciate that and wish you all the best with your endeavors for educating retail investors. I think we need many more people like yourself to impart that education to investors so that investors should not fear equity. Actually, they should embrace equity. They should feel comfortable with equity. we need to just recognize and accept the fact that equity markets will be volatile in the short term, but they'll do well over the longer term because they are linked to the Indian economy. So just invest into good quality companies or some mutual fund or products which are related to equity markets, which invest into good quality companies, and then stay patient with that over a longer period of time, and you'll be fine. So, in fact, I always tell people that not investing into equity is a much bigger risk than investing into equities. Because if you invest in the equity, there is a risk that short term, because of volatility, you might lose some capital. But if you don't invest into equity, then longer term, no other asset class will give you as much return, which as much as equities can give. So on that note, I wish you all
Right.
the best.
Thank you. Thanks a lot. And as I say, keep believing in the India story. Thank you a lot. Thanks.
Thank you. Thank you.
Bye.